Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 31st, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. This is for information purposes only. Please do your own due diligence. It's your money. It's your responsibility. So before we get started, I'd like to wish everyone a happy Labor Day. This is the end of the summer, basically. Most people should be coming back to work, and I think that we'll see some increased activity, hopefully, in some of the mining shares. So this is typically people come back to work after the summer, everybody's back, kids are in school, and we'll see what happens. So we've been tracking this metric on credit card defaults, or at least observing it, and we're now at levels of credit card defaults, delinquency rate on credit card loans that exceed both the great financial crisis and the tech wreck recession and the pandemic recession. So this goes back to, I think, what I finally realized, that we have this bifurcated economy where we have a certain percentage of the population that's doing very well and isn't really experiencing too much economic hardship, even with the higher inflation, higher cost of living. But then this very large cohort of people that is being affected, who haven't seen their wages go up and have seen the cumulative 20 to 25% rise in prices since the pandemic, and not seeing, their wages go up the same, they're getting squeezed. And so in order to try to maintain their living standard, or at least even try to live in some cases, they've resorted to credit cards. And so now the credit cards, minimum payments can't be made anymore, level of debt gets high, and now you're starting to just get into delinquency on credit cards. And I don't know, this looks like when's it going to peak? I don't know, but this is, like I said, this exceeds previous two major recessions that we had in the last 20 years, or three. So I think it goes back to kind of confirming, or at least solidifying, the view around this bifurcated economy of basically, high earners, people with assets that have benefited from the inflation, and the larger group of people that gets squeezed by it. And we're seeing the same thing in auto loan default rates. They're spiking now. We're back to getting to levels, at least in subprime auto loans, that exceed the great financial crisis and the pandemic. And we're also seeing prime auto loans now starting to spike. So again, a lot of people bought cars with their checks, made down payments. And so this is reflective of something going on in the economy. And yet I have, again, it just depends where you are. It's that Cantillon effect. If you're on the receiving end of the money, if you're in the renewable energy business or the chip making business or in construction around that, then you're benefiting, right? Because that's where the money's being poured into from the government. If you're in some other business that isn't getting that, then you may be suffering. So again, it's my contention that we are having weakness in the economy. Obviously, in manufacturing, the data is clear. Although manufacturing, I've said before, is only about 12% of the U.S. economy, services is becoming weaker. So we'll just have to see what happens. But this is not like great economic news. We're running 6, 7, 8% deficits relative to GDP. What would happen if you tried to balance a budget? What if you tried to do like Malay did in Argentina? Well, the economy in the U.S. would collapse if you took that fiscal spending away, that deficit spending, which is closing in on it's going to be a deficit of $1.9 trillion in this fiscal year. So what happens when you actually have a recession and automatic stabilizers come in, spending stabilizers come into effect, unemployment insurance, food stamps, all these programs that the government has as a safety net? Are you going to go to $3 or $4 trillion deficits? You know, and at what point does this start breaking the system? You know, you have $35 trillion in debt. And we're touting this as, you know, this is a terrific economy, the Biden economy. I'm not picking on President Biden. All these politicians say the same thing. They take credit when the headline numbers look good. They have no clue about economics. Okay. Again, you're trapped in this 2 and 4 year election cycle, so no long-term planning happens. Who cares about the debt? I won't be in office when it blows up anyways. That's how people think. And so, you know, this is why I'm bullish on gold and hard assets. There's only one outcome that's going to be inevitable here, and that's an extreme amount of money printing. U.S. pending home sales, worst level ever. Here it is. This is the best, you know, if you listen to the politicians, this is the best economy ever. That's what they say. If you listen to Wall Street, you know, no recession. Stocks are going higher. So this is from Larry McDonald off Twitter. I like this. This is showing the inflation, core PCE inflation. Here's where we're at approximately 2.62%, which doesn't seem high, but if you put it into a compounding calculator over 30 years, you lose a lot of purchasing power, like 3/4 of your purchasing power. But anyways, the point I'm trying to make here is the Fed's getting ready to start another rate cutting cycle at a level that was higher than their goal, which was 2%, which is down here. You know, these days of low interest rates and low inflation, that's over with because of many things that have changed that were true for the last 30 or 40 years that are no longer true. And I'm going to delve into that in the September issue of the Actionable Intelligence Alert newsletter. And this phase change in the way things are, which is going to be higher inflation, less globalization, lower living standards, more debt. This is going to have a profound effect on investments. It's going to be terrible for fixed income. Okay. And so that if you are somebody that's getting ready to get to retirement age, you're going to have to come up with another plan besides, you know, just getting CDs or treasury securities. Although I think that eventually the government's going to force most people to buy treasury securities, whether they like it or not, but that's down the road. And that's another discussion. But suffice to say is we're starting a rate cutting cycle, another money printing cycle at a rate of inflation that's higher than the goal was and what we have seen in the past. And so I'm very optimistic for hard assets. And you're going to see, it's going to be interesting to watch how the Fed and the pointy shoes in the government explain why this isn't a bad thing. They're going to have how they rationalize this. It's going to be very interesting. So this is from Katusa Research. It was on Twitter. I didn't realize this, but this is fascinating. At this point in the year, the GDX, which is the gold miners ETF, is outperforming for the year both the Nasdaq and the S&P. I don't know how many people had that on their bingo card this year, but that's a fact. I mean, it started out earlier in the year severely underperforming, but by April and by the late spring, early summer, we've seen the performance catch up and now exceed. So if you really look at like Ronnie Stoiffel's work in Gold We Trust, he has charts going back and showing gold's performance. It's basically outperformed many asset classes for the last 20 years. And I believe it's going to continue to do that. Now, you have to differentiate between the metal and gold shares, okay? And there's been a lot of disappointment, I think, with investors in the gold shares, but I think that that's starting to turn. I actually saw a chart. I don't have it here in this week's chart storm, but which shows that U.S. investors now are starting to allocate more money into gold shares and gold ETFs. So that's, if that continues, and I think it will if the gold price continues to move higher, which I believe it will as the Fed gets fully entrenched into its upcoming rate cutting cycle. And I think that I personally think that the economy just is going to be a lot weaker than a lot of people think. And I think that, yes, I understand the argument around fiscal dominance taking over from monetary policy, but I wonder how long that can continue. Again, I don't want to underestimate the potential because, as I've said before, as the great Felix Zulauf has said, he said this 3 or 4 years ago. He said that by the end of this decade, he sees the Fed's balance sheet at 40 or 50 trillion dollars. That's well within the realm of possibility. It's almost unfathomable now that it could go up 5 times, 4 or 5 times from its current. It's around 8 trillion right now. But why not? Eventually, you're going to have another recession. Eventually, the debt's getting out of control. The ability of the private markets to absorb the level of debt is going to become more and more difficult. And it's going to start dawning on market participants that this government in the United States is an irresponsible government, and people will stop buying the debt, notwithstanding the fact that we are running around making enemies of everybody around the world that used to buy our debt. I have a chart about that later on. But back to here, I mean, I'm bullish on gold and gold shares. Right now, there's several miners, some of the more senior miners that are doing very well. I think that eventually trickles down into a junior gold mining bull market, super bull market. Think what happened in uranium several years ago. Something similar, I believe, will happen to the gold shares, the junior gold shares. Timing, impossible to know, but I think it happens. And so, there's some very good, I think it's well worth your effort to investigate, or find and curate a following on X of people that understand the gold mining sector and have demonstrated demonstrable expertise that can help guide you, because there's it's a very, very difficult thing to do. And understanding, just buying, baskets of stuff, maybe it's better just to buy the ETF, because it's a lot of work and it's very difficult and specialized knowledge that most people don't have. So I think the demise of coal has been predicted many times. And here we have China coal demand, or at least imports, I meant to put imports, are up 13% year over year of coal into China. And again, energy inputs into an economy is what allows it to grow, right? And so electricity demand, energy input into the economy is what allows it to function and grow. And again, this is why I'm so bullish on energy, even though we haven't really seen a lot of moves here. I was listening to someone the other day. Somebody sent me a link to a podcast I think Doomberg gave, that we won't see $100 oil. I started to listen to it. I haven't had time to finish it. I respect Doomberg, and everybody has an opinion, but I don't need $100 oil for oil stocks, some of the oil stocks that I own, to work out, because in a range-based oil price of $70 to $90, there are many, many oil companies that have paid down their debt and that are cash flowing tremendously at these price levels. Unless you're going to see a collapse of oil down to 40 or 30 and it stays there for a couple of years, there are a lot of opportunities just based on these things being ATMs. The cash flows are tremendous. If your debt's paid down and you don't have a desire to increase production, then you have nothing to do with the cash except return it to shareholders via buybacks and dividends. And so, 10, 15, sometimes more of free cash flow being returned to shareholders. What's your total shareholder return, right? What's the value of the dividends and the buybacks that you're getting relative to what you're paying for the share? You can, this is about compounding wealth. And so you still always have that protection against inflation, because in an inflationary era, energy tends to do the best. That's what we've seen in the past. It's not necessarily gold as an inflation hedge, it's energy, and that makes sense. Why? Because energy is so ubiquitous and is an input into everything that we do. Chinese coal demand. So this was imports are up 13%, but this is coal demand overall in China, and it's it's above 2023 levels. So every year it goes up, just about. So yeah, I mean, I know people will say, well, the coal price isn't responding. Again, there are coal producers out there that have operations in thermal and in met coal that are cash flowing tremendously. And what are they doing? They're paying down debt and they're returning cash flow to shareholders. This is about total return. It's not about, well, when is the coal price going to go from 150 a ton to 300 a ton? Do you need it to have, if you need that to happen for your particular situation to work out with the particular entity you're invested in, that's speculation. If you have prices that historically are in a range and a company has assets that are valuable enough that it can cash flow and give you a decent return, then that's the conversation. Then you still have that optionality on the upside if in fact there's a coal price spike or something happens like we've had it happen before, right? There's typhoons that happen in areas in Australia that wash mines out, and then we get these spikes or what have you. Or the Chinese decide they're not going to import coal from Mongolia because they allowed a Buddhist priest to come there or who knows what. There's things like this that happen, but that cannot be your investment. Your thesis cannot be based on that. It has to be based on what's the actual cash flow in a reasonably in a price band for that coal can trade in. So GNR came out with their Q2, Goring and Rosenzweig came out with their Q2 quarterly letter. This is a chart that they put up, and they recreated this all the way back to 1900. If you read the article, if you read the newsletter, it's always about 30 or 40 pages. Tremendous. I always look forward to it. I usually have to read it 2 or 3 times. It's so jam-packed. But anyways, this chart basically shows you the commodities as it relates to the Dow Jones and the ratio, basically showing you that commodities are overvalued here and undervalued when they're down here, okay? And so we're in a situation, and they go through this, they talk about this era, they talk about this era, they talk about this era, and what the similarities are and what the differences are and what they are forecasting. And so basically what they're saying is we are likely in an era here, and I'm not going to go into why, but you could see the tremendous historical undervaluation, which is at this point a record, at least what they've been able to reconstruct going back to 1900. So there it is. I mean, this is one of the main themes. It's the pushback is, well, when's it going to happen? Why isn't it happening? When's it going to unknowable? So what we try to do is put ourselves in a situation where we have the most highest probability of an outcome. And based on, it goes back to these poker analogies that I like to use. Certain hands that you're dealt have a certain, if they're played correctly, any single hand can blow up in your face. I've had it happen before when I used to play online poker. I'm attempting to play the thing correctly, and, some guy comes in wild and just gets the cards to fall his way. But if you play the hand consistently the same way 1,000 times or 5,000 times or 10,000 times, you're going to come out, the percentages are what they are, but any single situation can blow up in your face. So this is what we're trying to do here. What's the probability that commodities are undervalued relative to the Dow Jones, at least in this particular example? And then what has happened in the past? And what has happened in the past is that, again, one of 3 or 4 outcomes can happen. The Dow Jones can come down, commodities can stay the same. Commodities can go up, the Dow Jones can stay where it's at. the Dow Jones can come down and commodities can go up. I mean, there's all different ways for this to reconcile. But when you get to these so far out of whack valuations relative to each other, we've seen what's happened in the past. Now you can say, well, if you're going to compare it to this era, this took 10 or 15 years before it turned up. Yeah. But I think a lot of the situation is the same. You know, we're in an era of inflation, high debts, around $315 trillion of worldwide government debt. We're in a deglobalization, which is going to raise prices and inflation. We're basically in World War III, where we have this bifurcated Anglo-Saxon Atlantis hegemon that's starting to crumble as we have this new emerging market, BRICS, emerging as the new political economic leadership. Okay. And so that's causing problems. So we have a lot of things that, in my mind, you know, a lot of things that we had that we didn't have. And like I said, I'll talk about this more in the September issue. You know, when we had this big run, you know, people always say, well, Volcker crushed inflation and we had this era of prosperity with Reagan. Well, that wasn't the only thing that happened. There were other things that happened also, right? That helped give us decades of low interest rates and low inflation. You know, we had the collapse of the Soviet Union. They were desperate for hard assets. So what did they do? They were flooding the market with commodities, okay? And they were selling things cheap to get cash flow. You had the emergence of China, this huge labor force that was basically being paid pennies on the dollar. You know, they started out making, you know, plastic dog poop and novelty schnozzes and stuff like that, and then graduated into higher and higher technical equipment or doing, you know, semi-skilled or low-skilled assembly work. And now they're doing things a lot higher up on the technical scale. Okay, that's over with. The wages have went up, costs have went up, to the fact that a lot of people are moving. Then you're also creating an enemy with China, and so you're sanctioning them. You're telling them we're going to be an enemy. That these are all going to raise costs. And so a lot of things that were happening over the last 3 or 4 decades are no longer in existence. Rates are probably have bottomed, are going to be heading up over the next couple of decades because of the fiscal irresponsibility of the governments of the West. No one's going to want to buy their debt. Therefore, rates are going to have to go up to compensate people for the risk of these irresponsible governments. Inflation is going to be higher. We just talked about the PC. They're starting a rate cutting cycle with inflation higher. They never got it down to the goal of 2%. So a lot of things are going to reverse that allowed, you know, lower commodity prices, lower real asset prices. And I think, you know, underinvestment has happened. We've had over a decade of underinvestment. So all these things are coming together to create a perfect storm for higher commodity prices. And I'll delve into it more in the September issue. So here's some comments from the Q2 letter from GNR, from Groen and Rosenzweig. He's talking about, they're talking about commodities here. He's talking about the cyclical nature, which we've talked about before, of resources. The cyclical nature leads to distinct periods when commodities are glaringly undervalued relative to equities. Moments when commodities present tremendous investment opportunity, and others when they were expensive and best avoided. This is what I like. There are times, this is not a one-way bet. There will be a time to sell. They do become overvalued at some point. Going on. Over the past 125 years, commodities have reached these points of extreme undervaluation relative to equities on 4 notable occasions: 1929, 1969, 1999, and most recently 2020. After each of the first 3 lows, commodities and natural resource equities went on to dramatically outperform the broader market, and we suspect history is poised to repeat itself. All signs point to the early stages of a prolonged commodity bull market, likely stretching into the 2030s. The problem is, you know, people don't have the patience. Again, as I've said before, when you look back on this thing, you're going to see over a decade or more a chart going from the lower left of the chart to the upper right, signifying a tremendous bull market. You will see little squiggles in there where you had cyclical pullbacks based on recessions or who knows what, but the overall trend will be up. And so I think, you have to, this is where you say, you make a general statement, say, okay, commodities and resource bull market, and then you look at the individual sectors in there, and then you have to understand the cyclicality and what's the characteristics are and what the current situation in each one of those commodities is. And again, this is work. There's a cycle in copper, there's a cycle in oil, there's cycles in these things, investment cycles, specific situations that go back to, in some cases, politics, like in copper and mining in general. It's becoming more and more difficult to mine in certain jurisdictions. So this is where, you're going to have to do the research. It's not just, okay, buy and hold. I think you could, if you buy a basket of BHP, Rio Tinto, and Glencore, you'll probably do fine, right? And then just ride the wave, the ups and downs and the volatility. But, I think you have to, if you're more surgical, you're going to enhance your returns. So this was a chart talking about the environmental impact study for the next gen, the big mine that they're trying to bring online. And a lot of people are thinking it's going to come online, I think, sooner than what's possible because of the environmental impact studies and things they have to do. So this tweet was talking about, for those expecting construction to start as early as Q3, Q4 2024, keep in mind we're at step 3 of the EIS. And basically, the view is they're not going to produce any uranium at least before 2030. And this is one of the big mines that was supposed to help alleviate the uranium deficits that are staring us in the face. And so this is from a slide from NextGen. It's talking about the process overview of the Canadian Nuclear Safety Commission environmental assessment process under the Canadian Environmental Assessment Act. And so they're only at step 3 of this process. Now, I didn't delve deeply into this, but basically, you could go back and read this, investigate it more, but this is the problem with just assuming that, well, all this uranium is going to flood into the market. I mean, it takes a decade plus to bring a uranium mine online. And yes, we've been able to turn on some of the brownfield shutdown facilities, like I've talked about Encore doing and Boss Energy. But the big new greenfield mines, I don't see anybody building anything. I don't see anybody even talking about building anything except for, Global Atomic trying to build DASA and trying to get financing for that. And with the coup and some of the geopolitical situation, the way it is in Niger, is that, or is it not going to happen? And that's not going to be enough. And then with the recent news with Kazatomprom, I mean, and then, people are like, well, where's this uranium bull market? If you look at the term pricing, somebody put a chart up of term pricing for the last several years. It's gone up every year. You're up 41% this year. In what market that's oversupplied do prices go up consistently month after month? Again, take your focus off the spot price. I don't even look at the spot price except for entertainment value. The one thing that I use it for is it drives sentiment. It makes things that I want to buy cheaper. No one has illustrated to me in a coherent manner why. I mean, there's like tremendous short interest on a lot of the uranium stocks. Now, they are overvalued relative to where the price of uranium. They ran ahead of themselves. Okay. But I think, there's an opportunity there, and people just get frustrated because they don't have patience. Again, if the thesis is there, again, Rick Rule said this, the easy money's already been made, guys. So it's going to be more difficult. And so you're going to have to watch sentiment. You have to pick your spots. It's not just buying stuff at pennies on the dollar and having like long-term call options. It's not really like that anymore. But again, I don't see anybody making announcements that, okay, we're going to go into Namibia and partner with Deep Yellow and spend, billions of dollars or whatever it's going to take to bring these new mines online. I don't see any announcements. When I start seeing that stuff, then I'll start the clock for 10 or 12 years before the thing actually gets built and produces uranium. In the meantime, we're staring at 20, 30, 40 million pound deficits that are going to build on themselves going forward. And the world's largest uranium miner basically saying, having problem after problem being able to maintain production or increase production. I mean, this is like I said, if this was actually traded on the NYMEX or Chicago Board of Trade, the price probably would have doubled already. So we'll see what happens at the WNA conference, which I believe is next week in London. And we'll see that everybody's back from Labor Day now. Things should start resolving around the Russian import ban and waivers. I think there's a lot of things that have kind of like held things up, but inevitably you have to buy more fuel. Okay. There's a deficit. And so it's round and round with the teacher over there with the record player. Remember, it's going to be musical chairs. Somebody's going to get left out. So we'll see what happens. I think we're going higher. I don't know exactly what the catalyst will be, but we'll see. Again, on the demand side, it doesn't stop, right? China now leads the world in nuclear power, at least according to the Chinese Nuclear Corp. It says on August 29th, the State Council Information Office released the white paper revealing that China now ranks first globally in nuclear power capacity, with 102 nuclear units in operation and under construction, totaling 113.13 million kW. Recently, 5 new nuclear projects with 11 units were approved, solidifying China's position as a global leader. Currently, 56 units are operational, generating 58 million kW, with 46 units under construction, adding another 55 million kW. This is just China. India's building out their reactor. I mean, we've talked about this before. So you're adding reactors, extending the life of reactors, trying to bring reactors back online. This speaks to another thing. What are we doing in the U.S.? How come, we've made some progress, but it's too slow? I would like to see this kind of like space race type effort put into nuclear energy. It touches so many pain points on both sides of the political spectrum. Jobs, STEM, climate change, economic development. It's akin to a push like Eisenhower's interstate highway system and the almost immeasurable, you can't even probably, I'm sure economists have tried, just the amount of spillover economic benefit you would get from something like that. And we used to do things like that in the US. We used to have visions. The Chinese have a vision. Now I understand it's a command and control economy. Get it? If they want to build 100 reactors, they're going to build 100 reactors. Okay. I understand that. But, this is something I think that we're going to have to do. Everybody's already sweating the power grid and the base load power and add all these renewables and AI and data centers. This helps solve all these problems, and we should have like a crash program on this. But of course, we get tied up in things that don't matter. So again, this is just another, John Quake's reporting on what I just showed you from the China National Nuclear Corporation. So here we have Switzerland to lift new nuclear plant ban. So Switzerland was another country that they didn't decom their units, but they put a ban in effect after Fukushima. Politically motivated to ban, reactionary emotional response that we're going to ban all new nuclear, panic, hair waving, hair on fire, arms waving. And so they've decided they're going to lift this ban because they have to. It makes sense. It didn't make sense to ban it in the first place. So this is an article. It says the Swiss government said it will seek to lift the country's ban on the construction of new nuclear power plants, which has been in place since January 2018. It said all clean energy sources will be needed to meet expected electricity demand while also meeting climate targets. Switzerland currently has 4 nuclear reactors generating about 1/3 of its electricity. They all have an unlimited operating license and can be operated as long as they are safe. So they go on to say here, quote, one of the officials, in the interest of responsible planning of electricity supply security, the Federal Council is therefore striving for technological openness. The existing ban on building new nuclear power plants is incompatible with the goal of technological openness and also entails risk for the dismantling of existing plants. So again, another brick in the wall. Again, none of these announcements are singularly by themselves going to be the catalyst, but it's like we're piling, the avalanche upwards in prices, if you will, the volcano that's going to explode of higher uranium prices. Tremendous pressure is building under that, and so I want to be part of that. This is like something's going to happen. Does that mean we can't have more weakness? We can certainly have more weakness in the uranium price. It's just that opaque and that strange of how it works. It's not like price discovery is not immediate like it is in the oil market or copper market or gold market. I guess you can make the argument that people will make the argument these things are manipulated, what have you. But you have this small clique of people that calls each other up or texts each other or is on WhatsApp and texting back and forth and playing around. And then you have companies, utilities, negotiating directly with mining companies and others, and these things are not reported, so we don't really know what's going on until after the fact. But we do see over time that the term price is going up. So it's just a lag in information, in my view, notwithstanding the fact that we have this ban in effect now. We have uncertainty in the market. And then we also have, again, a lot of people just were off for the summer, in my opinion, and there probably wasn't a lot of deals happening. Now everybody's coming back to work. Everybody's going to the conference. We'll see what happens. So I wanted to point this out. These are historical dividend yields of different markets. Like you see the S&P on the bottom, then the MSCI World Index, MSCI Emerging Market, and then the MSCI, I think this is Europe, Asia, and Far East. So what I'm saying is I think we're in a position now with the Fed cutting rates, going through a rate cutting cycle, that the dollar is very likely going to weaken. If you look at intermarket relationships in the past, this is what has happened. The whole world now will be all in sync with their rate cutting. And so I think as the US cuts rates, some of the other central banks have already been in a rate cutting mode. If they slow down their rate cuts or hold them where they're at and the US is cutting, then the dollar could conceivably weaken and we could have an emerging market rally. I still think that longer term, I think the pieces are in place for higher returns from emerging markets or other markets outside the US going forward for some period of time, but we shall see. But I think at this point in time, it behooves you to look around the world. I mean, I saw even on Interactive Brokers now, they're going to open up I think they just recently allowed trading on the Athens market in Greece. They are opening up trading in the Malaysian market. So there's always ways to take advantage. There's different shares you can find to take advantage of different countries. You can travel to these places and buy real estate. I think with the internet and communications being so cheap and ubiquitous, so many ways to communicate, and it's not that hard to get on a plane and go somewhere, having this home country bias, I think, really has a tendency to limit your total return. I really don't think you should do that. I mean, you have to be careful because rule of law and all these things, a lot of things come into play, but you have places like Singapore where shares are very cheap right now. Hong Kong, the same thing. There's opportunity around the world with companies, I think, that will do well and that are trading historically, very cheap. And so why not at least look at these things and see if it fits into your risk profile? But most people don't even think about these things. They don't even want to look at. They just have this home country bias, which I think you are not going to be able to do going forward if you want to outperform. So we're getting into the political part of the show now. If you use it, don't like it, you should probably switch off. So this is part of the situation I was talking about of why I think, things are reversing. We had 30 or 40 years. You can look back here to 1995, 2000. It was just recently under the Trump and Biden administration that the sanctions regimes have really ramped up. And this is a change. And this is why I think now you have so many countries that are interested in joining the BRICS. If you're being sanctioned, I mean, the article that this was attached to, this chart, it said that U.S. has sanctions on 60% of low-income countries. Is that going to motivate them to be more open to dealing with the U.S. or less likely and more open to dealing with China, Russia, India, and the rest of the BRICS countries? One of the things that Americans aren't very good at, or Europeans, they are very, let's just be honest, they think that they're better than everybody else. I don't think that if you ask the average person, they won't say that. But I think, the people that are in charge, the elites, they just think that, you're going to do what we say because we're the best, our system's the best, we know more. And that's, I have my own views on some of these things, but if you want to have if you're trying to change someone's views, yes, okay, there are tyrannical regimes around the world. The best way, in my mind, to undermine them is to have as much contact with them as possible in, business, political, cultural. Sanctioning the leaders doesn't do anything but hurt the people. And then it's used as a propaganda device in the country to help prop up the regime. If you want to get rid of the Cuban regime, you should have as many Americans and Europeans and Canadians going there spending money as possible. People would be like, wait a minute, something's not right here. Okay. Instead, you're sanctioning the regime, the people that run the regime, and they don't care about the people. So you're not accomplishing what you're trying to accomplish. And so you're driving these people together because now they have an alternative, which is the BRICS. I'm not saying it's going to be better. I'm not saying it is better. I'm saying that's what's happening. And that's going to, I think, have a distinct part. It's a distinct part of my thesis around why things are going to be more difficult in the world going forward. Things are going to cost more. Things are going to deglobalize. Things are going to break down into at least two or maybe more trading blocks. This is not good for overall for the whole world, but this is apparently where we're going because the U.S. is losing its hegemon, whether it likes it or not. Okay, the thing that Brzezinski and others like of his ilk warned about, if you read the book that he wrote, he talked about this. This is going back to, I think, the 1994 when the book was written, 95, talking about an alliance that needed to be avoided between China, Russia, and Iran. And here we are in 2024, 30 years later, and there you have this alliance now. And I'm not saying it was all the U.S. causing it, but the U.S. hasn't helped itself here. And the U.S. certainly doesn't have the capability that a lot of people think. The Red Sea is the Houthi, for all intents and purposes, the Houthis defeated the U.S. Navy. They control basically who comes in the bottom part of the Red Sea. Where's the U.S. Navy? Its only job is to project power and keep sea lanes open. It cannot do that, evidently. Yet it's sitting offshore Israel right now, ready to get involved in a war with Israel, between Israel and Iran. Not good. So I wanted to show this. We've seen this before. The poorest people buy lottery tickets. It shows here average household income of a zip code. The higher the income, the lower the lottery ticket sales. Obviously, what I'm pointing this out is you're going to see, more gambling, more people trying to keep up with their lower standard of living, trying to get out of poverty by gambling, lottery tickets, stock speculation, crypto. That's why you see this stuff. And you see like people that, have the lowest income spend the most money on lottery tickets. And I think you could even equate health with this too. The poorer you are, the less healthy you are, and I think you could actually, I haven't done this, and this is going to tip people, but you could probably overlay IQ with this too, and some other factors, time preferences. It'd be interesting to do this study. But, then you're starting to get on dangerous ground, and people get nervous and they start looking at their shoes and, excusing themselves from the conversation because they know where it's heading. But anyway, this is, drug abuse, alcohol abuse, maybe not alcohol abuse. That's actually pretty, I think, spread across socioeconomic. But regardless, I think a lot of things, the less educated, the less, I mean, I believe the military still has it that on the ASVAB, if you score a certain low score, I think, which equates to like an 83 IQ, they will not let you in the military. So I still think they have those standards. But anyways, this is what you get. And I think you're going to see more of this as the economy becomes more difficult. People are going to be looking for an easy way out. I think you're going to see more. You see this typically in, when economies start, beware of like get rich quick schemes, things like that. So this is the last meme. I don't care what anybody says. I'm to the point in my life now where I don't really work for anybody. I don't really care. I'm not going to be, if I'm silenced, I'm silenced. It doesn't matter to me. But the satanic neo-Marxist plan to replace the native populations of the West continues. And I thought this meme was great. And this is two headlines from The Guardian. Over here, I like these. It says, Europe, stop having children for the environment. Having children is bad for the environment. Having children, women, that's bad. Have your career first. Then when you get, 30 years old or 40, try to have a kid. Then the kid has Down syndrome. I read an article the other day, even men, the longer you wait to have children, the more potential genetic defects you pass on. And so that's what they've told everybody, right? Depopulation, get rid of the native populations, get rid of the nationalistic pride, the culture that goes back thousands of years or 1,000 years in Europe. Okay, get rid of it because it's bad. And so, don't have children above replacement level. So now we have labor shortages. We can't fund our retirement schemes. So what's the solution? Bring in the peasant class from the third world. And so I like what it says here, the malevolence of the EU. Here on the one Guardian article, it says, want to fight climate change? Have fewer children. And then on the right, you have refugee influx helps halt decline in Germany's population. But to what effect? Are the best and brightest coming to Germany? It doesn't look like this. Looks like a bunch of young men sitting around like malingering and, raping young girls and harassing people and now becoming radicalized into Islam. This is not going to end well, guys. And I have said this before. This is going to end one of three ways. Either you're going to realize that this is a problem and try to reverse it by saying no more immigration from the third world. And a lot of these people have to go back, okay? And we're going to pay you to go back. Do you think that's going to happen? The second one is you're going to have a level of violence that is incomprehensible to the average person to physically remove these people. Do you think that's going to happen? Or third, eventually the native population will continue to shrink. These populations will continue to increase, and then you'll just become a minority. Not in your lifetime, maybe in your children's. If you don't have any, you don't care, or your grandchildren's. You're going to be like the Plains Indians were. You're going to be put on reservations. You're going to be a minority in your own country. and you're going to be victimized. The victimization has already started. The rapes, the beatings, it's all over Twitter and YouTube. It's not one-offs, it's every day. Another 13-year-old kid was stabbed yesterday in the UK to death by some third worlder. Why wasn't the guy at his plumbing job or being an anesthesiologist? They're out in the streets harassing people, victimizing people. Are they going to contribute to the pension schemes? Are they going to contribute to the declining population? Are they going to be productive members of society? No. And as this rise of Islam happens, what's going to happen is the native populations are going to continue to shrink. They're going to become minorities, one of other minorities in a huge racial spoil system where you have nonstop conflict. And again, this is another reason why, I believe that the main issue here in the U.S. in this election, the only thing that I care about in this election is I want immigration completely stopped. Okay, we need to take a breather. We need to deport millions of people. But do I think that's actually going to happen? No, I don't. Why? People say, well, yes, it will. Trump said, no, well, the people of the United States won't accept the level of violence it will take to deport 10 million people. You can deport 10 million people. It's been done. It was done in Germany. It was done after, it's been done a lot of times. Czechoslovakia deported many Germans after World War II. Okay, the level of violence it requires, what are you going to do? Just walk into somebody's house, grab the whole family, throw them across the border, put them on a plane back to, Guatemala? You don't think CNN and MSNBC are going to be standing right there with cameras with the tears of the little girl clinging to her mother? We had a life here, blah, blah, blah. They're going to show you the trains from the 1940s going from Germany to Poland, creating that in your mind, and people will say, that's enough. The emotions and the rhetoric will overcome it. Can we even get rid of the violent criminals? I mean, I read an article this weekend where evidently in Aurora, Colorado, these Venezuelan criminals that have just came across the border from Venezuela, gangs, have taken over apartment complexes, kicked out the rent-paying tenants, and are refusing to pay rent. And the government's not going to do anything about it. The local government doesn't know what to do. They're outgunned and outmatched. So you're going to have these like criminal feudal kingdoms start popping up, extorting. I mean, this is in the United States of America, guys. This is happening. And it's not one-offs. Are you prepared to do what the president of Nicaragua did, which is gather all these people up and put them in a prison for the rest of their life and hold them there, or get rid of them? Get rid of them? Do you know what that means? No, you're not prepared to do that. And so prepare for the consequences. All right, that's it for this week. We'll talk to you next week. Thanks.